and welcome back to Financial Triage, where we talk about financial planning and how you might apply it to your finances. Today's topic is my favorite topic, taxes. At the end of today's class, I hope you will understand more about your personal income tax return and ways to reduce your lifetime taxes and grow your net worth. As there has recently been a new tax law proposed that came out of the House Ways and Means Committee last week, we will also discuss how those potential changes may impact your tax return if it becomes law. Note about this proposed law, it is not law yet. The reason we talk about it is because it has a lot of provisions in it that have been talked about for a lot of months that may end up becoming law in the next year and a half. And so just to get ahead of it and be aware of upcoming changes, we will let you know as we talk about the different topics what might be changing. But important note, it is not law yet. We are going to cover a lot of information in each episode. As everyone is in a different place financially and has different values and goals, not all of this information will apply to you. You can download the slides using your camera app on this QR code, which we will show periodically during this broadcast. If you have questions, please note them in the chat at any time. We will answer all questions at the end. As we are going through these topics, if there is a particular segment, topic, or situation you would like to see as a future seminar, please leave it in the chat or email the organizers at academy@bedfordpresbyterian.org. My name is Jennifer Climo, and I love all things financial planning and income tax. I have been providing income tax advice to individuals and small businesses for over 30 years, and I've been providing financial planning advice to individuals and couples for over 18 years. I'm a certified financial planner, CFP, and I'm also a CPA certified public accountant. Disclaimer, the views expressed today are mine alone and are not the views of either Bedford Presbyterian Church or Milestone Financial Planning. Nothing you hear today should be considered investment advice. Do not make financial or investment decisions based on this or any other seminar, but instead meet with a qualified financial advisor regarding your specific goals and financial circumstances before making major financial decisions. Note that almost all financial decisions will impact your income taxes or your estate taxes now or in the future, and the tax consequences should be evaluated before you take action. And most importantly, past performance of investments does not predict future results. TRIAGE is the acronym we came up for this series of classes. Today's topic is the T in TRIAGE, taxes. There are ways you can save thousands or tens of thousands of dollars in taxes over your life. As we go through this material, I'm going to keep it as general as possible and not list out every possible exception or possible applicable scenario. Also, I apologize in advance for the mind-numbing complexity of the topic. Taxes are very complicated. In the days of Jesus, one of the disciples asked, "Is it right to pay taxes to Caesar or not?" To which Jesus replied, "Give to Caesar what belongs to Caesar, and give to God what belongs to God." Paraphrased, Matthew 17 and 21. Before we get into a discussion of the types of taxes you might pay, we are going to go through your tax return from income to taxes due. Let's start with total income. Total income equals all income received. Everything you receive is taxable income unless it's exempted by the Internal Revenue Code. So if you receive money from any source, you are technically required to report it as income, regardless of whether or not you receive a tax form. Total income can include wages, dividends, interest, capital gains, unemployment, 1099 income, pensions, annuity distributions, IRA distributions, and Social Security, among other things. Income is further broken down into at least two categories for different tax calculations. Earned income. What is earned income? Earned income is wages and self-employment. Income from your job is an easy way to think of earned income. Earned income is commonly used to determine whether or not you can make an IRA or a Roth IRA contribution, among other things. Tax calculations are often based on either earned income or unearned income. What is unearned income? Unearned income means different things for different areas of the tax code. In general, this is income that is not wages or self-employment income. For example, interest and dividends, rental income, capital gains, passive income from various investments. These are all examples of unearned income. Unearned income is also used in various calculations in the tax code. So these are two terms, just two of several terms that you're going to need to understand for today's discussion. Now that we understand total income, we will discuss deductions. Deductions are items you get to subtract from your total income to get to your adjusted gross income. The adjusted gross income, which we'll explain more in a moment, is abbreviated AGI. I'm going to talk about AGI a lot. It means adjusted gross income, and it is a calculation that we're going to talk about right now. These deductions that are subtracted from total income to get to AGI are known as above-the-line deductions, not to be confused with itemized deductions or the standard deduction, which come later. Above-the-line deductions may include things like self-employed health insurance, HSA contributions, small business retirement plan contributions, IRA contributions, pre-2018 divorce alimony, educator expenses, student loan interest, etc. Though there are others, those are some of the big ones. Total income minus above-the-line deductions equals adjusted gross income, or AGI. Very, very important. Please remember this concept. This is labeled as such on your tax return. After adjusted gross income, we get to deduct more things, either the standard deduction or itemized deductions. Everyone receives a standard deduction of $12,550 if you're single, $25,100 if you're married filing joint for 2021. Since 2018, when these limits were increased, most people now take the standard deduction. Remember, a deduction is a subtraction from income. You would only itemize your deductions if they totaled more than the standard deduction. Examples of itemized deductions are if you pay $10,000 in real estate taxes or state income taxes, if you have mortgage interest, if you have medical expenses that you did not pay with your HSA that exceed 7.5% of your adjusted gross income, then you can add them as an itemized deduction. Or my favorite, if you are very generous with your church or 501c3 charities, you get to deduct that as well. All of those things add up together, and the total of those itemized deductions would need to exceed the standard deduction for it to make sense for you to itemize your deductions. Important note on the charitable deduction that you cannot deduct gifts to political organizations, GoFundMe, your friends or family, or random people you are helping. Those are not 501c3 charities and not tax deductible. There are a few other unusual itemized deductions, but these cover the bulk of them. Regarding medical expenses, I've had several clients living in assisted living facilities where their room and board was considered 100% deductible as medical expenses. If you know anything about the cost of this care, you know it can be $10,000 to $15,000 per month or more. By matching the taxable income taken with their IRA with a medical deduction that exceeds 7.5% of their adjusted gross income, they paid little or no income taxes on the remainder of their IRA they used to pay for nursing home care. This is one example of ways to save lifetime taxes, is saving a portion, if you can afford to, saving a portion of the IRA for later in life care. This does require tax planning. You can sometimes completely avoid the income taxes on the last amount in your IRA. Believe it or not, the Bible discusses paying taxes. Pay your taxes too, for these same reasons. For government workers need to be paid. They are serving God in what they do. Romans 13:6. We're going to move off your tax return now for a moment and talk about types of taxes. There are many different types of taxes that U.S. citizens and residents pay. Property taxes on houses and cars, income taxes, federal income taxes, state income taxes, self-employment taxes, otherwise known as FICA or Medicare taxes, you might see that on your pay stub, estate taxes, gift taxes, extra Medicare taxes for high-income individuals, hidden taxes such as the extra Medicare premiums assessed for 1 year if your income is too high, and value-added taxes. What is a value-added tax, a VAT? You might have heard the term. This is a super sales tax added at every stage of the production process for a good and results in the cost of products increasing by the amount of the tax. The US currently does not impose a VAT, but many other countries do, especially some countries in Europe. Most financial decisions have a tax impact. I wanted to say all financial decisions have a tax impact, but I'm sure that we can probably find some that don't. But in my experience, pretty much all financial decisions have a tax impact. For example, did you buy a house this year? If you took a mortgage, you may be able to itemize your taxes as you can deduct mortgage interest, but only on a mortgage up to $750,000. And real estate taxes are also deductible, only up to $10,000. Did you sell your house this year? Because the real estate market has been so crazy, it is very possible you may incur a taxable gain if you sell your house for more than $250,000 than you paid for it, or more than if you're single, and more than $500,000 than you paid for it if you're married filing joint. Again, the calculations aren't quite this simple, but as a general rule, you might want to look into that or talk to your accountant. Investing in a business opportunity. Find out the form of entity you are investing in. I have several clients that come up to me and say, hey, I want to invest in this great business opportunity, or worse, I already invested in this great business opportunity. And how's it going to affect my taxes? What they don't realize is if you invested in something called an S corporation or an LLC, two forms of entity of different businesses, any profits the entity makes may add to your tax bill, even though you don't get any money out of it, you don't get any distributions. Other things that result in tax consequences. A new thing, moving around cryptocurrency usually results in a tax consequence. I'm going to give an example here. Not everybody will know it, but the people that are playing with cryptocurrency will understand. If you use cryptocurrency to trade other cryptocurrency on, for example, Uniswap DeFi protocol, or you use it to buy goods and services using Strike, those are taxable transactions subject to capital gains. And many people don't realize this, and they are going to be surprised at the end of the tax year. The regulation around this is growing, and I would expect that soon that information is going to be reported to the government. And even if it isn't, as we learned on slide 1, all income is taxable income unless specifically exempted by the Internal Revenue Code. So it does need to be reported whether or not you get a tax form. Another example of something that affects your taxes is that you cannot legally use bartering to avoid paying taxes. Hey, I'm going to trade you that camera for this TV. Well, the amount of the camera that comes to me is income to me, and the TV to you is income to you. Technically, don't shoot the messenger. Social Security and Medicare taxes are additional taxes that you probably pay on your paycheck. Social Security tax is 6.2% times the income paid by the employee, and then the employer matches that, an additional 6.2%. If you are self-employed, you work for yourself, you have to pay both halves of that tax. So right off the bat, you're paying 12.4% of your income in taxes and Social Security taxes, and that doesn't even get to your income taxes, which are going to come later. This is paid on the first about $143,000 in wages for 2021. The reason it stops is that benefits received are limited, and there was originally supposed to be some correlation between taxes paid and benefits received, although low-wage earners received a higher percentage of benefits for the taxes they pay than high-wage earners. Medicare taxes. Medicare taxes are 1.45%. Why can't they say 1.5? 1.45% times the income paid by the employee and the employer, 2.9% total. Once again, if you're both the employee and employer, you work for yourself, you pay both halves of that. That's an additional 2.9% taxes on top of the 12.4 that we already had before we even get to income taxes. That is higher with adjusted gross incomes. There's that previous term we described. Total income minus above the line deductions, adjusted gross income. If your adjusted gross income is greater than $200,000 single or $250,000 married filing joint, then you pay an additional 0.9% on the additional income above those limits, additional wage income. There is no cap on Medicare taxes. It goes as long as you have earned income Medicare taxes continues that 1.45 or 1.45 plus 0.9%. There's an extra 3.8% tax paid on unearned income for high-income individuals, those with income greater than $200,000 single, $250,000 AGI. For the purpose of this extra 3.8% Medicare tax, the definition of unearned income, not wages, not your job, all the other stuff, unearned income, is limited to mostly interest, dividends, passive income, and capital gains. This tax only applies to income above those limits above. So if your adjusted gross income is less than $200,000 single or $250,000 married filing joint, you don't have to worry about that tax. The American Families Plan, not this tax law that came out of House Ways and Means Committee, it is not yet the law. However, it has proposed extending this 3.8% Medicare tax to S corporation profits if you are active in the corporation. When this tax was originally proposed, it only covered unearned income, and now the proposed change is to include S corporation profits in that, but only if your income exceeds $400,000 single, $450,000 married filing joint. I know there's a lot of these limits, but they are mostly the same: 200, 250, 400, 450, with a few outliers. So if your income is less than those amounts, you don't have to worry about any of those extra taxes. Estate taxes are calculated on the net value of accumulated assets at death. Federal exemption limits are currently very high, but may be reduced if tax reform passes this year. In my career, this limit has been as low as $675,000 and later $1 million. Currently, the limit is about $11.7 million per person, so it affects very few people. However, the American Families Plan, proposed plan, not yet law, halves these limits to about just under $6 million per person. Still doesn't apply to all that many people. Some states still have very low limits, like Massachusetts. Massachusetts has a $1 million estate exemption. New Hampshire does not have an estate tax. To give you an example of how the estate tax would affect you on a federal level versus a state, you might say, hey, I'm never going to have 11.7 million, and I might never even have 5.8 million. But if you live in Massachusetts and you own a house, housing costs in Mass housing values have shot up. You have a 401k, some bank accounts, little other investments, and life insurance. Yes, life insurance proceeds are generally included in your estate. They are not subject to income taxes, but they are subject to estate taxes. So if you have life insurance proceeds, 401k in your house, you're probably over $1 million. And the issue with Massachusetts is they will tax you, if you're over the $1 million, they tax the entire $1 million or the entire amount of your estate, versus the federal limit. If the federal limit is $5.8 million and you have $6 million, then you're only taxed on the $200,000 difference. So that's a difference in the tax. Obviously, the Massachusetts state tax rate is much, much less than the federal tax rate. I think the federal tax rate is 40%, and the Massachusetts state tax rate varies depending on how big the estate is, but maybe from 4 or 5% up to 12%. Gift taxes are applicable on gifts made that exceed $15,000 per year per person. But the excess of those amounts are only taxable if you die with assets in excess of the estate tax limit. The federal limit is currently, as we discussed, $11.7 million per person, possibly going down to $6 million. But as we know, that will only be, in general, you can give people whatever you want, but if you're ever going to die with an estate that becomes a taxable estate, they will bring the value of those excess gifts in and tax them. And the tax is paid by the donor, by the way, not the person you give it to, but the person doing the giving. New Hampshire income taxes. Believe it or not, New Hampshire does have some income taxes. They consist of the interest and dividends tax, which is 5% on interest and dividends above $2,400 a year if you're single, and $4,800 if you're married filing joint. Another tax is the business profits tax of 7.7% of business income for businesses with gross receipts greater than $50,000. That's a pretty low limit. New Hampshire does not tax individuals on income, so pass-through entities such as S corporations, LLCs, and partnerships have to file standalone New Hampshire tax returns, and they're subject to the New Hampshire profits taxes if they're above the limit, the $50,000. Many sole proprietorships in practice don't end up paying this tax because you can also deduct the business owner's estimated compensation up to certain amounts. There is also a 0.6% tax on business interest, payroll, and dividends paid, and this is applicable to businesses with gross income greater than $222,000. This tax offsets the business profits tax above. Basically, the calculation of taxes is super complicated. The above list of the kinds of taxes is comprehensive. Pretty much any financial decision will have an impact on one or more of these types of taxes. This is why it is so critical to get financial advice from a professional that has tax knowledge. Otherwise, you can get burned. Going back to income taxes, let's look at a tax return. I don't know if anyone took me up on my suggestion to bring a copy of your tax return to today's talk. There is a big difference between tax withholdings and income taxes due. Many kinds of income have mandatory or optional tax withholdings, like 401k distributions, IRA distributions, annuity payments, Social Security payments, etc. Tax withholdings on this type of income is usually 10% or 20% right off the bat. Please note, these withholdings are not a calculation of your specific tax liability. They are instead a base withholding rate. Let's look at the tax return form. On the return, you have your income less your above-the-line deductions equals your adjusted gross income, line 11 of your tax return. Then you get to deduct either your standard deduction or your itemized expenses to get to your taxable income. This amount is multiplied by your marginal tax rate. This is a simplistic explanation of the calculation. However, keeping it relatively simple, if you're under age 59 and a half and your current marginal tax rate is 22% and you take a distribution from your 401k of $10,000, your plan is probably only going to withhold 20% or $2,000. And you're going to think, oh, I paid my taxes on that amount, I'm good. And then at the end of the year, you do your tax return and you realize, and I do get this question all of the time, people think they've paid their taxes on this distribution when they've only paid the mandatory federal withholding. Your tax rate might be 12%, it might be 35%, somewhere in between. And if you're under 59 and a half, you may pay a 10% penalty. Therefore, back to our example, if your tax is due on the $10,000, if you're in the 22% tax bracket, $10,000 times 22% is $2,200. The 10% early distribution penalty, because you were under age 59 and a half when you took that, 10% of $10,000 is $1,000. That's $3,200 in taxes due. You only withheld $2,000. You're going to owe $1,200 on top of everything else. A lot of people don't understand this, and when they take a distribution of any kind from any kind of income source. So there is a difference between your specific tax situation and what gets withheld from any kind of income. These are simple examples. Your paycheck is a much more complicated example of this. You may or may not be withholding enough. Let's take a look at your last filed tax return, if you have it. Look on page 2 of the 1040, where it lists your total taxes after some credits, before any payments or tax withholdings. This is line 24. This is your tax liability for the year. You then deduct any withholdings or estimated tax payments and refundable tax credits to get to your tax owed or refund due. Note that your tax refund means you overpaid your taxes during the year. Those monthly payments you are getting from the U.S. government for the child tax credit and or the reduced health insurance premiums you pay from buying your health insurance through the federal or state exchanges, those are decreasing the amount of payments you will have applied to your tax bill and reducing your potential refund. It's all going to be reconciled on your tax return at the end of the year. Now, this may be offset because you're going to get larger tax credits. That's why they're advancing the tax credits, because they don't want people to have necessarily a huge tax refund. They want people to have the money during the year. But if you have a different tax situation this year, or a lot of other income, or you're under withheld in other areas, when you're doing tax planning, you really need to think about all of these things together and see how they affect you. The only way to know for sure you haven't underpaid your taxes is to prepare a tax projection, which is an estimated tax return. And that includes everything specific to your tax situation. We're going to have a brief discussion of the American Families Plan here, and then we're going to talk a lot more about this at the end. The proposed new tax law from last week, the American Families Plan, increases the credits for kids over age 6 to $3,000 per child starting in 2023. It leaves the amount for the kids under age 6 still at $3,600. This credit phases out between AGI of $75,000 to $200,000 if you're single, and $150,000 and $400,000 if you're married filing joint. It's a sliding scale. The more your income, the less of the credit you get. It uses the lower of this year or next year's income to make this determination. So if you have a low tax year or a high tax year, you can use the other year to qualify for the credit. And if the government overpays you during the year, you don't have to repay it unless there's fraud or you deliberately understated your income on your tax return. That's very similar to the health premium tax credits that are extended in this proposed tax law. Last year they passed this, or earlier this year, they passed the health premium tax credits so that no matter what your income was, your health insurance is limited to 8.5% of your income, your premiums. Obviously, if you have very high income, that won't apply to you because your premiums won't be as high as 8% of your income. If you get your health insurance through yours or your spouse's employer, this does not apply to you. This only applies to people buying health insurance off the exchanges. Those are the ones that have their health insurance costs limited to a certain amount of their income. Also, if you get too much of a health subsidy during the year, you don't have to repay it unless there was some sort of fraud or deliberately understating your income, as mentioned below. Now remember, this American Families Act stuff is not yet law. I do expect that parts of this, a lot of people, professionals expect that parts of this are going to become law because they've been talking about this and other tax increases for a year now. So it is highly likely that this will parts of this at least are going to pass. So again, if having health insurance not exceed 8.5% of your income only applies if your income is greater than 400% of the poverty line. If your income is under 400% of the poverty line, the subsidies are higher. I don't have those exact amounts, but there's complicated calculations based on number of family members, your income, and where you live and the cost of different insurance. And again, just to reiterate, there are no protections for those getting health insurance from their employer. Also, if you were offered health insurance through your employer, you are not allowed to go to the exchanges. Okay, so here, as we can see, 400% of the poverty line is about $69,000 for a family of 2, and about $105,000 for a family of 4. Also, the income used to measure this is a version of adjusted gross income. As I mentioned before, adjusted gross income is the starting point for a lot of different calculations. Extra savings dates. At age 50, you can add additional funds to your 401k, 403b, TSP, IRA, Roth IRA, and other retirement plans. At age 55, you can add an additional $1,000 to your HSA, and so can your spouse when they turn age 55. Magic dates. Some of these magic dates affect retirement, so we're not going to cover all of these today. The ones we don't get to today, we will cover next week when we talk about retirement planning. Once you hit age 59 and a half, there are a number of birthdays that impact your taxes. 59 and a half is the age when you can withdraw from a qualified retirement plan, 401ks, 403bs, IRAs, etc., without the 10% penalty. Age 62 is the earliest age you can start collecting Social Security. We're going to discuss this in much more detail next week in retirement. Suffice it to say that most people collect at age 62 because they can, not because it is the best financial planning decision. But again, we're going to talk about that next week. There are many advantages to waiting, which we'll talk a little bit about the advantages today. Age 63 is the year that your adjusted gross income determines your age 65 Medicare premiums. If you are 63 or older, note that your Medicare premiums are determined by your income 2 years ago. So you need to factor that in. The very first time you collect Medicare, if you had high income in a prior year, you may be able to get a waiver on your premiums by filing a form, SSA 44, and applying for a waiver based on circumstances. For example, if you leave your job when you first retire in the same year that you collect Medicare, you can usually get that waived. Or if a spouse dies and you suddenly move from a joint table of Medicare premiums to a single table, which is a lot lower, like half as much income, then that can also give you a waiver on that form. But an important thing to note, a lot of people don't realize their Medicare premiums are determined by their income. If your adjusted gross income is over $88,000 single or $176,000 married filing joint, you may be hit with this higher Medicare premium. It is known as IRMA. I forget what it stands for. If you are first eligible, when you are first eligible for Medicare, like I talked about, you can file the SSA 44. When you are 70 and a half, you can make qualified charitable distributions of up to $100,000 per person from your IRA to a charity. This transfer satisfies your required minimum distributions if you're over age 72. We'll talk about that, what that means in a minute, what a required minimum distribution is. And this IRA distribution does not appear on your 1040. It's completely off your tax return. It effectively gives you a tax deduction without itemizing. So if you don't itemize your deductions, you can technically take a tax deduction for this distribution because it is not taxed. And also, you don't have any forced taxation of required minimum distributions if your minimum required distributions are less than $100,000. This is one of my favorite planning strategies for charitably inclined individuals. Note, really important note, that if you do this qualified charitable distribution, which is known as a QCD, the financial institution still will issue a 1099. And so it is up to you to tell your accountant you made a QCD so they don't accidentally tax you on that 1099 because they wouldn't otherwise know. So again, I'm a big advocate and everybody should actually look at their own tax return. Try not to be intimidated by it, that you won't understand it. There are some things that you may know, especially if you did a QCD and you look at your tax return and you look at the income line, there shouldn't be that amount in the IRA distribution line that you know you gave directly to charity. Age 72 is the required minimum distributions start from IRAs, 401ks, 403bs, TSPs, etc., and other qualified retirement plans. Note, whoever prepares your tax return controls its results. This decision is super important because not all tax decisions are clear-cut. Whoever is doing your tax planning should coordinate with your tax preparer to make sure the end results are reported as expected. Also, you should look at your tax return. Ask questions if you don't understand something. You know more than you think. What is a required minimum distribution anyway? These are known as RMDs for short. When you saved initially into your 401k or 403b, IRA, or TSP, you received a tax deduction and promised the IRS you would pay the taxes on that amount of money plus anything it earned later in life. A required minimum distribution, or RMD, is the amount of money you are required to remove from your IRA or 401k, 403b, TSP every year and be taxed on. The RMD for your IRA is due by April 1st of the year following the year you turn 72. After that, you must take the distribution by December 31st each year. Because of this rule, we suggest you take your first RMD in the year you turn 72, so you don't have to take and be taxed on a double RMD the next year. You calculate the RMD using the prior year December 31st ending balance of your account divided by a number from the IRS life expectancy table. Many people don't realize that they don't have to take the money out of their investments. We often transfer a client's RMD out of their IRA and into their taxable brokerage account, less the taxes. You just need to be very careful that you withhold enough income taxes because that is taxable income, or that you're paying in estimated income taxes to cover it. In essence, you have to be taxed on the income, but you don't have to take the investments out of your investments. It just has to come out of the IRA wrapper and can move into another account if you don't need the money. You can also combine all of your IRA RMDs into one number and take it just from one of your IRA accounts if you wish. You cannot do that if you have a 401k or a 403b, you have to take the required minimum distribution directly from each account separately in those cases. The American Families Plan has a provision that probably isn't going to apply to too many people. If you have combined retirement accounts, IRAs, Roth IRAs, 401ks, 403bs, TSPs, etc., of over $10 million, you will now be subject to a super RMD of 50% of the amount over $10 million. If you are lucky enough to have more than $20 million, you have to be taxed on everything over $20 million and 50% on the difference between 10 and 20, which is at least a $5 million required minimum distribution, which is income, taxable income in that year. That's if this law passes. Remember, this is not yet law. If this does become law, it has come out of the House Ways and Means Committee. So if it does become law, that's going to be one of the revenue raisers. But again, it only applies to $10 to $20 million of account balances, combined account balances. However, the RMD has to come out of the Roth accounts first. So essentially empties all the Roth IRA accounts, which are the accounts that grow tax-free, and then the difference would come out of whatever account you wish. And if you're under age 59 and a half, these distributions are not subject to penalty because they are forced mandatory distributions versus a voluntary distribution. The concern with this is these amounts are not indexed for inflation. So I always go back to the limits of, I don't know what year Social Security income started being taxable, but it was well before I started, maybe in the 70s, and they decided that Social Security would start being taxed at $34,000 of income, which seemed really high way back then. And today, obviously, not high. That was not indexed for inflation. Things that aren't indexed for inflation tend to creep. Okay, that's the end of the American Families Plan discussion for right now. We're going to talk about all the other provisions at the end. If you inherited an IRA, I'm going to talk about non-spouses inheriting IRAs. If you're a spouse and you inherit an IRA, you can just keep it. There's no, I would say there's not really any hardship if you are a spouse. If you're a non-spouse and you inherit an IRA from a parent, let's just say, or a sibling, before January 1st, 2020, then you also have to take an RMD, also based on the December 31st prior year balance, divided by a different life expectancy table, and then adjusted by subtracting one each year. If you inherit an IRA from a non-spouse this year, there are no more RMDs. They got rid of that in one of the recent tax laws. But you may need to empty the account within 10 years. So you're likely to want to move 1/10 of the account each year to keep your income tax bracket lower, because if you have a large income source in any one year, it could really boost your income, and then which can have other effects, like making you subject to some of these other taxes that are based on certain income levels. As with everything, there are exceptions to this. There's exceptions to everything in tax law. Just trying to cover the basics. If you are married, tax planning tip, I've had this happen. If you were married and you were well under age 59 and a half, and your spouse dies young. Very sad. When this happens, often you don't have significant assets built up outside of the 401k, and so you'll want to, you may want to open a spousal inherited IRA. If you can either put the money in your existing IRA or in something called a spousal IRA. If it's in your existing IRA, it's locked until you're 59 and a half. You don't want to do that. If you're young, you want to consider putting it into a spousal IRA where you can take a required, you don't have required minimum distributions, but you can take distributions without an 10% early distribution penalty. If you put it into your own IRA, it is now locked until 59 and a half. Now, if you have plenty of assets, say you've got life insurance too, so you have plenty of assets outside the 401k, then great, no problem. You can put it in your own IRA because you don't need that money. But that is something that I have seen, and you want to consider if you have somebody who passes away young. Oftentimes, the financial institution, if you don't have a professional helping you, and you call them up, and you say, my spouse died, and they will just send you a check or put it into the put it into a regular IRA. They're not going to lead you down that path necessarily, so you need an advocate to help you with that, to make sure it gets it gets moved correctly, because you want to avoid the 10% early distribution penalty. All right, using strategies to reduce your lifetime taxes paid. The best way to reduce your lifetime taxes paid is to prepare a tax projection before you incur the tax, so you know the tax consequences before you take the action. That's before you sell your rental property or buy your rental property, before you sell your business, before you cash out your 401k, before you make a partial Roth conversion, etc. A tax projection gives you answers and possible strategies for reducing taxes on the transaction if you structure it a little differently. You just don't know how extra income is going to interplay with other items on your tax return and impact your tax rate. Common pitfalls for adding additional income include: you might pay extra taxes on your Social Security. As I've mentioned, Social Security can be non-taxable, partially taxable, or up to 85% taxable, depending on your income. Extra taxes on your capital gains. There is a 0% tax rate up to certain income limits. If you bump up over those limits, then it jumps to a 15% tax rate and possibly a 20%, depending on the extra income you have given yourself. Reduced deductions that are based on income, like charitable deductions of appreciated stock. Those are limited to 30% of your adjusted gross income. Or medical expenses. Medical expenses have to exceed 7.5% of your income. If you make your income higher, then fewer medical expenses will be deductible. You could have a reduction in the business deduction on qualified business income if you're self-employed. Especially if you're a self-employed professional that is not an engineer or an architect, then that deduction on that income is limited based on how high your income is. You might accidentally increase your future Medicare premiums. This is probably the thing I see the most, is that people do not realize that their income starting at age 63 impacts their Medicare premiums 2 years later. Or they have a high income event after age 65 when they're on Medicare, and then 2 years later, surprise, your Medicare premiums are $475 a month. What? So you just need to be aware that that's a thing. Did you know your regular 401k, IRA, TSP, 403b plan is a huge tax bomb? Any money withdrawn is taxed at ordinary income tax rates. So if you need to withdraw $25,000 for expenses, this is when you're over 59.5, you may expect to actually withdraw $35,000 or more to cover the taxes on the withdrawal, which increases the taxes due on the withdrawal, which means you have to take out more to cover the taxes on the withdrawal, etc. So you really need to pay attention to the tax impact of any extra income. Roth IRAs, we've talked about these a little bit. There are two types of Roths. There's a Roth IRA and a Roth 401k, and they're different. They are also the same in some ways. Sounds weird, but a Roth IRA is an account where you don't get a tax deduction and the assets grow tax-free. Same with the 401k. Roth 401k, you don't get a tax deduction, but the assets grow tax-free. You may know that in order to make a Roth IRA contribution, which will grow tax-free, your adjusted gross income must be less than certain amounts. About $124,000 for those filing single and $196,000 for those filing married. If your income is over those amounts, then you are not eligible to make a Roth IRA contribution for that calendar year. A Roth 401k is very similar, but there are no income limits. It is also subject to the same contribution limits as a regular 401ks. The amounts grow tax-free. Whether you should contribute to a Roth 401k or a regular 401k is a decision you need to make each year based on your income and expected income in future years. Note that every year should be considered separately in a vacuum when doing tax planning. It might make sense in 2021 to contribute to a Roth 401k, no tax deduction, because tax rates are relatively low. But if Congress increases tax rates substantially in 2022, and especially if your taxable income is over $400,000 single or $450,000 married filing joint, it may make sense to make a regular 401k contribution that year, next year, to get the tax deduction. That's if some of these extra taxes pass. Tax planning is super important for these situations. Not only do you have to pay attention to tax rates and your income, but you have to pay attention to the new laws that are coming down the pike. It does get complicated. This next section is a super awesome tax strategy that may be eliminated if the American Families Plan becomes law. But right now, it's an important tax saving strategy. So I don't know, I didn't want to skip it because this isn't law yet. And one way to get around the income contribution limit is to do a type of conversion, Roth conversion, called a backdoor Roth. Many people have probably heard of this term. If the Families Plan passes as it's written, this is going away next year. And there will be no more backdoor Roths, no more conversions of any after-tax money, which also means no more mega backdoor Roth, if you know what that is. I'm going to briefly cover what those are because this isn't tax law yet, so maybe those aren't going away. I don't know, and they're really a great strategy if you are, in order to save lifetime taxes, if you qualify. The only reason this would really apply to you is if your income is over the limits to contribute to a Roth IRA. So you're not eligible to contribute to a Roth IRA, so you've been making a non-deductible IRA contribution and then immediately converting it to a Roth IRA. That only works if you have no other IRAs. You can't have a SEP IRA or a simple IRA or an IRA with any money in it for this to work. The reason is being any basis, any taxed money, if you will, that taxed money gives you basis in the IRA, reduced taxes, and that comes out pro rata. So it goes in, you get the tax deduction, it's a non-deductible IRA, there's no tax deduction, but when it comes back out, you have to spread it out with all your other IRAs. Bottom line. Okay. So if your company allows for after-tax contributions to your 401k, you can also contribute more money than your 401k. Let's say you're putting the maximum $26,000 into your 401k because you're over age 50 and you have enough income so you can afford to do that. Then sometimes your company may let you also add after-tax money into an account at your 401k. It's not your regular 401k, it's not your Roth 401k, it's this extra account for after-tax money. You add to that as well. It's usually limited to a percentage of your income. And when you leave your employer, the Roth IRA, the Roth 401k money goes into your Roth IRA, the regular 401k money goes into your IRA, and the after-tax money also can go into your Roth IRA. That is known as a mega backdoor Roth. That is also going away next year if this law passes. So if right now, if you have previously done a backdoor Roth and you've heard of this and you already are eligible to do it, you don't have any other IRAs and you do a backdoor Roth every year of your $6,000 or $7,000, you need to make the contribution and make the conversion in 2021 as a precaution in case this passes. Sometimes people wait and do the conversion later. Don't. Do it all now. And the same if you are already participating in this after-tax contributions, this mega backdoor Roth strategy, you need to wrap that up before the end of the year in case this goes away. Oops. What about partial Roth conversions? A Roth conversion is when you take some of your IRA and you transfer it into a Roth IRA. Anything taken from your IRA is taxable income unless you made a non-deductible contribution, as in the backdoor Roth we just discussed. However, it can make sense, especially if you're in a lower earning year or you expect tax rates to rise in the future. A great time to make a Roth conversion is when your other income is very low. An ideal window for this can be between retirement and age 63, before your income is used to calculate your Medicare premiums. So you want to be careful doing too much Roth conversions. At 63 or older, you need to always understand that not only do you have income taxes to look at, you also have the additional Medicare tax that you will pay in higher Medicare premiums 2 years in the future. The next best window to make partial Roth conversions is before you start collecting Social Security, because once you start collecting Social Security, that is a lot of additional income that bumps up your tax rate, which again, remember, impacts not only your tax rate, but also your Medicare premiums once you're over age 63. So this is one reason we like to tell people to wait to collect. If they don't need the money, they're very healthy, they expect to live into their 80s, then if you wait to collect Social Security, you have a lot bigger of a window to make partial Roth conversions. Partial Roth conversions is one of the biggest ways to decrease your total lifetime income taxes. Tax planning during the year is so important. People often fail to consider the impact of additional income, as we have talked about. Social Security claiming strategies. I'm going to table this until next week so we can spend time talking about the American Families Plan. Next week, we're going to discuss retirement planning. But just remember, a great way to save lifetime income taxes is to defer claiming Social Security until age 70. But again, that's if you do expect, who knows when everybody's going to die, right? But if you know when you're going to die and it's under age 80, then you probably should collect. And if it's not, then wait. Health savings plans. Health savings accounts are another tax saving opportunity. This is one of the very few deductions that does not phase out with your income. If you have an HSA-eligible health insurance plan, you should fully fund your HSA to the maximum limits, which are $3,600 single, $7,200 family this year. They go up for inflation every year. You can contribute an extra $1,000 per spouse over the age of 55, not 50, 55. These contributions can come from you via your paycheck, or you can transfer the money directly into the HSA, or your employer can put the money in the HSA. But all three of those together cannot exceed those limits. So if your employer gives you $1,500 towards your HSA, then you can only contribute, and you're, let's say, married, under age 55, you can only contribute $7,200 minus the $1,500. HSA balances are great because not only do you get a tax deduction, but they also grow tax-free if used for medical expenses. Not health insurance premiums, but medical expenses. They can be used at any time, or you can not use them at all. You can fully, if you have the cash flow, and you can fully fund your HSAs, they grow tax-free. Just let them grow. If you have the cash flow, use other money to pay your medical expenses, and this is a way to supercharge and account for your retirement medical expenses, which you absolutely will have, because you will at least have dental bills or vision, hearing aids, as well as prescription costs tend to go up as you get past age 65. So it is great to have an extra pool of money to fund that, and then it grows tax-free as an extra bonus. Also, if you are lucky enough to have if you can contribute to your HSA through your employer pre-tax at open enrollment, if they let you take the entire, let's say they don't put anything in to your HSA, but you want to fully fund it, you're married, so you want to put $7,200 in. You take $7,200 and you divide it by your 26 paychecks per year, and that's the amount you put in every paycheck to your HSA. You do that, you have just saved Medicare and Social Security taxes, otherwise known as FICA taxes, on that contribution. Note that just because your health insurance plan has a high deductible does not mean it is HSA qualified. An HSA qualified health plan will usually have that right in the title. It'll just say HSA, or it will say saver. If it doesn't say either of those two things, I would question if that's an HSA eligible health plan. You can always check with your health insurance company if you are not sure. You can only contribute to an HSA if you have an HSA qualified health plan. And once you are on Medicare after age 65, you can no longer contribute to your HSA, but you can still use it to pay for your medical expenses, or you can continue to let it grow tax-free. A low tax bracket is a terrible thing to waste. If you have a bad year and low income, it may be the year to move a portion of your IRA to your Roth IRA at a low tax cost. These are partial Roth conversions, as we talked about a little bit. I once met with a small business owner. When I took them on as a client, they had been incurring net operating losses of $20,000 to $50,000 per year from their business that passed through to their tax return. So they were in very, very low income, negative income. It was a shame because they could have converted that amount every single year, plus an additional $20,000 or so for the various standard deductions that you're allowed, tax-free. They could have converted from their IRA to their Roth IRA and paid zero federal income tax. However, they didn't, but then there was another year. They had a $100,000 business loss a few years ago. We're able to convert the entire spouse's IRA to the Roth, about $130,000 for zero federal income tax. Now, Obviously, it's not ideal to lose $100,000 on your business. Don't run out and do that just to convert your IRA. But if you have an unfortunate situation that makes your income very, very low, then you can make partial Roth conversions. Unfortunately, Roth conversions are scheduled to be ended starting in 2032 if the American Family Plan passes in its current form. And I believe that is only for the high income, those with incomes over $400,000 single, $450,000 married filing joint. Charitable giving. If you are charitably inclined, there are several ways you can take advantage of the tax code and meet your charitable giving goals. Qualified charitable distributions, which we talked about a little bit already, donor-advised funds, and gifts of appreciated stock are all relatively easy ways to meet your charitable goals and get a tax deduction. Please join us in class number 6, Generosity, where we get into all of these details. They can really supercharge your tax savings, as well as meet your charitable goals. Let's discuss the hidden tax on Medicare premiums I keep referring to. The base Medicare premium, once you're 65, is about $150 per month per person. But only if your adjusted gross income is under $88,000 if you're single and $176,000 if you're married filing joint. You can see that on this chart. These limits change every year. This is to calculate 2021 premiums, and you'll notice they are based on 2019 taxes. The higher your income, the higher your Medicare premiums for that 1 year. Since the premiums are only affected for 1 year and are based on your income from 2 years prior, this is essentially an additional hidden tax. And the tax can be quite high. And you'll notice the other thing that's a little bit scary is that the married limit might be, hey, you know, I have income of $176,000, so we're just paying $150 per person for our Medicare premiums, and that's great. But unfortunately, one spouse passes away, now you're back into the single limits, and $176,000 of income, even if your income goes down to $150,000, that puts you in the bracket where you're paying $386.10 for your Medicare premium instead of $150. So this is a big deal for some people. Obviously, if your income is less than these limits, and always will be, not such a big deal. There is a different limit for Part D premiums, which is your prescription health coverage. So there are additional penalties there, again, for very similar limits. I think they're the same limits. Deductions for the self-employed. Very small business owners get some additional tax deductions that are above the line or in the adjustment section of your tax return. These generally do not phase out. For sole proprietorships and partnerships, these include health insurance for you and your family, long-term care insurance premiums for you and your spouse, and retirement contributions. Some of those also apply to other entities as well, such as S corporations. However, if your net business income is, for example, $150,000 or less, you may be better off with a solo 401k with a Roth 401k option than with a SEP IRA. $150,000 of income, if you make a SEP contribution, SEP IRA contribution, that's capped out at 20% of your income or $30,000. If you instead had a solo 401k, you could contribute the 401k limit of $19,000 if you're under age 50 to your 401k, $26,000 if you're over age 50, plus 20% of your net income. Again, $150,000 of net income is $30,000. $19,000 plus 30. If you have a 401k, you can contribute $49,000 if you have the cash flow. That's if you're under age 50. And if you did the SEP, you could only contribute $30,000. So it depends on A, your cash flow, whether or not you have employees, and how much money you want to save, which retirement plan is best for you. Also, solo 401ks tend to be a little more expensive to administer. SEP IRAs are very, very easy and simple. And note, the profit sharing contribution for your solo 401k has to go into the regular 401k. So even if you're putting your $19,000 of 401k into your Roth, the match, profit sharing, would have to go into your regular. You can't throw it all into the Roth. If you have employees, then a SEP IRA may not be for you because you have to contribute the same percentage to everyone's account if they've worked for you for more than 3 years. So if you put 20% in your account, you have to put 20% of salary into all your employees' accounts. Therefore, if you have employees, a simple IRA may be a better choice. Very easy and simple and cheap to administer. There are lower contribution limits than a 401k, about $3,000 a year lower. And you have to match your employee contributions up to 2 to 3 or 3% of their salary each year. You can put a maximum of $13,500 in it for yourself, $16,500 if you're over age 50, versus $19,500 for a 401k, $26,000 if you're over age 50. So the limits are different, but the trade-off is super easy to administer, super cheap, a lot less paperwork. Important note that even if you make a SEP IRA contribution at 20% of income, you are capped at $58,000 total contribution for the year, $64,500 if you're over age 50. Other business deductions. There's also a relatively new business deduction on qualified business income that may result in a deduction of 20% times your net business income. There's a tons of limitations and exceptions to this that is beyond the scope for today, but you should be aware this exists and you should look for it on your tax return. If you're self-employed and you have income on your tax return, you need to look to see that the Form 8995 or 8995A was attached to your tax return. I have seen tax preparers miss this in the past. Even if you don't qualify for the deduction due to the various limitations, that calculation is done on the 8995. At least it should have been considered. Note that many businesses don't qualify for this deduction if their taxable income is over certain thresholds. Basically, any consulting business, such as accountants, lawyers, performing artists, doctors, healthcare, financial advisors, cannot take a deduction if their taxable income is over certain limits. This is taxable income, not adjusted gross income, taxable income. But engineers and architects are specifically exempt from income limits. So no matter how high their income, they get this deduction regardless of income. Thank you, lobbying. Bonus material. Selling real estate. All right, so I have a question. It's a trick question. I flip my board. And I do have messy writing, for which I apologize. This is something I see all the time with the sale of real estate. Let's say you bought a piece of property for $500,000 and you rented it for however many years, 10 years. 10 years later, you have taken $50,000 in depreciation deductions and you sell it. You sell it for $850,000. You pay $50,000 in commissions. So on board, you've sold it for $850,000. You paid $500,000. You paid commissions of $50,000. You took $50,000 of depreciation over the lifetime, and you have a mortgage of $350,000. My big question is, what is the taxable capital gain here? I don't know if anyone is willing to take a stab at this, but I see many real estate business people that don't understand this. Do you want to take a stab?
That was a head scratch, not a volunteer.
Oh, that's too bad. So a lot of, does anyone? Everyone's pointing it. So
you paid the, well, there's the difference, so there's the $350,000 right off, plus.
All right, let's.
Depreciation recapture has to go in as gain.
Yes, good.
And the commission would come off.
Right.
It's a loss.
Correct. So those wipe each other out.
Right.
So I don't know, probably the audience can't hear Sean. So we have $350,000 wiped out. These offset, the commission offsets the depreciation add back. What about the mortgage, Sean?
I don't know. What about the mortgage?
I'm asking you. You got $350,000 in cash. Well, actually, you got $300,000 in cash, and you paid off the mortgage. You actually don't have any cash. What is the capital gain? Don't forget, this is a trick question. Okay, fair. The answer is, Sean was right. $350,000, the mortgage does not factor in whatsoever. Yay, Sean. So a lot of people don't realize that the mortgage is completely irrelevant to this calculation. If you take out a mortgage when you buy a piece of property, the government does not care. It is strictly what did you pay, what did you pay for the property, what was the sales price, what were your expenses, and how much you wrote off that you have to reclaim. So good job. Okay, now we get to the fun stuff. All of the changes coming through the American Families Plan, which are not all on the slide. So you actually have to listen to get all of the changes, or the majority of the changes that affect the tax code. Again, this is not yet law, but all the features in this have been talked about for a long time, and it's highly expected that if tax law does pass in the next year, that some of these aspects will be included. They almost all apply, almost all, if your taxable income is greater than $400,000 single, $450,000 married filing joint, except for there's extra taxes and then there's extra benefits. So we'll start with the extra taxes and then we'll get to extra benefits that are going to apply to other people. Almost every American is going to be impacted by this if it passes. There's something for everybody. S corporation profits. If you run a small business, you own a small business, and it's an S corporation, and your profits come through and flow through your tax return, that is currently exempt from the 3.8% Medicare surtax. Under the American Families Plan, it is no longer exempt. It is subject to the additional 3.8% surtax. Again, this is only for taxable incomes over $400,000 single, and in this one case, $500,000 married filing joint. I don't know why they can't keep things all coordinated, but that one's different. The long-term capital gains rate, this one is most important. Have you made any sale and incurred any capital gains since September 13th when this passed? Well, guess what? If your income is over those limits, you're subject to a 25% capital gain if this passes. So if this passes in the future, the capital gains tax rate is retroactive to now. So for people, if you have any chance of earning more than $400,000 single or $450,000 married filing joint, be very careful incurring any more capital gains between now and the end of the year. As we mentioned before, Roth conversions will be banned starting in 2032. Again, this is based on taxable income over $400,000 single, $450,000 married filing joint. The top tax rate will increase from 37% to 39.6%. The super RMDs we talked about for super large retirement accounts of $10 million or $20 million, those only apply if for people with high incomes of over $400,000 single, $450,000 married filing joint. And again, those high income folks with those huge IRAs cannot continue to contribute to retirement accounts if their balances are over than $10 million. There will be new annual reporting for any kind of 401k or IRA plans that aggregate in total more than $2.5 million. Those amounts will be reported to the IRS. Now we get to some of the benefits. The law will extend the current high child tax credit, which we talked about a little bit, and the earned income tax credit. It also eliminates the Social Security requirement for qualifying children. In fact, the kids that you take care of don't even have to be your children. You can use the prior year income or the prior year income to qualify for this child care tax credit. And the definition of a qualifying child is now called a specified child, somebody who lives with you, is younger than you, and is under age 18, and who you care for. Again, this hasn't passed yet, but if this passes, this is what this looks like. It extends the dependent care tax credit for daycare, makes it refundable. It increases it to $8,000 of expenses per child, up to 2 kids. The phase-out doesn't now begin until income of $125,000. No difference for married, just $125,000. But it is indexed for inflation. There is a 50% credit rate, so if you incur $10,000 of expenses per year, times 50% is $5,000. You can deduct the $5,000, subject to an $8,000 cap per child. That 50% rate reduces down to 20% at higher income levels, and the entire credit phases out at adjusted gross income greater than $500,000. Also, employer-sponsored dependent care plans at work. If you contribute to one of those to pay your daycare expenses, that would be permanently increased to $10,500 under this proposed new tax law, which is more than double what it is now. There's also a new credit for caregivers, up to $4,000 per year, that phases out very slowly. This is for people giving care to the elderly, the disabled. It phases out slowly, starting at adjusted gross incomes greater than $75,000, all the way up to income of $325,000, where it's totally gone. The law also extends the higher health insurance tax credit permanently that was enacted in one of the more recent legislations. We talked about that a little bit earlier. And again, that only applies for people that do not get their health insurance through their employer. If you get it through the exchange, it applies, not through your employer. But the healthcare credit now becomes permanent and covers 80% of your health insurance premiums if it applies through the exchange. The American Families Plan kills a few popular gift and estate tax maneuvers, one of which is an irrevocable life insurance trust. One way to keep life insurance out of your estate, if you remember when we talked about estate taxes, life insurance proceeds are included in your taxable estate in certain circumstances. One way to avoid that was a way to set up a kind of a grantor trust and called an irrevocable life insurance trust and have that own the life insurance. That could remove it out of your estate. It seems that is no longer going to be a thing. So all those irrevocable life insurance trusts may no longer do what they were designed to do. You can no longer use your IRA to fund your business if this law passes. That was sometimes people could use their 401ks or IRAs. They had to follow very strict rules, but there was a very narrow window of being able to use that to start up a business. You can't do that anymore if this law passes. Also, your IRA can no longer hold investments that are offered only to accredited investors. Thank you, Peter Thiel. If anyone had heard about, I think Peter Thiel had grown a $2,000 Roth IRA to $5 million or something, because he had some fancy investment that he was allowed to do because he was an accredited investor, which usually means you have certain income and asset limitations. They want to get rid of that ability. Also, as we discussed, the estate tax exemption will be reduced by half, from about $11.7 million down to just under $6 million. There will be a 3% surtax on adjusted gross income greater than $5 million. There will be higher corporate tax rates, but only for profits greater than $5 million. And individual energy credits are back. There was formerly a lifetime cap, $500 or so, on certain energy-saving products. That lifetime cap will be replaced with a $1,200 per year maximum credit, and the 30% credit for solar or geothermal will be back through 2031, again, if this bill passes in its current form. So we will stay on top of this, obviously, but that is some interesting stuff. I love new tax law. Next week, we're going to talk about retirement planning. Can I afford to retire? It will not be as lengthy a seminar as today's was. This is very dense. There will be a lot of numbers calculating can I afford to retire, but I will leave extra time to talk about specific examples if anybody wants to bring in some hypothetical situations and throw them at me. If you are interested in a deep dive on any topics, comments, or suggestions, please be sure to send an email to the address listed on the screen, academy@bedfordpresbyterian.org. Now, if anyone has any questions on taxes or the American Families Plan, this proposed law, if passed, again, has the potential to impact every American. I don't know if there are any questions. Thank you. Yes, microphone, please.
I have a question.
Yes.
What is a Roth IRA?
Excellent question. So a Roth IRA is an account that grows tax-free. There is no tax deduction for putting money into a Roth IRA, as there is for a regular IRA, but it grows tax-free kind of forever with limitations and restrictions, but in general. So that is the benefit to it, is that people like the thought that they won't be taxed on that money. So if you're in a low tax bracket today, you put money in a Roth IRA. You do not need to put money in a deductible IRA, because if you're in a 12% tax bracket, you're only saving 12% on that money, and later in life, most likely when you take it out, you will be in a higher tax bracket. Therefore, you would only save 12% on your taxes versus paying, let's say, 30 in a future year. Doesn't make sense. So with low income tax years, you contribute to Roth IRAs that grow tax-free. High income years, when you're in high tax brackets, that's when you want to, if you're in the 35, 37, or the new 39.6% tax bracket, you might want to contribute to your regular IRA or your regular 401k and take the tax deduction. Any other questions? One more audience member.
Hey, Jen. Are there any age income limits that will allow you not to file taxes?
Yes, there are no age limits, but there are income limits. If your income is super low, you don't have to file a tax return. However, there are reasons to file tax returns now, because there's a lot of things that are based on your income on your tax return, and certain credits that are paid, as we found out, stimulus payments were all based on your tax return. So sometimes it might make sense to file a zero tax return, even if you don't have to file. I don't know those numbers, those limits off the top of my head, but they're pretty low. I want to say, I don't know, $15,000-ish. Any other questions?
What is the benefit of a backdoor Roth IRA?
So the benefit of the backdoor Roth is that because you're unable to make a Roth contribution, it allows you to put into a Roth anyway and grow your money tax-free. So if people are already saving, say they're in a high tax bracket, they're already saving in a regular 401k to the maximum, the backdoor Roth allows them to also put $6,000 or $7,000, depending on their age, into the Roth IRA and let it grow tax-free. It's just indirect, because they have to first put it into an IRA and then convert the IRA to a Roth IRA. That is the advantage. There is no initial tax deduction. It's just the ability to get some tax-free income. So we'll talk about next week in retirement. It is advantageous in retirement to have tax diversification in your assets. If you remember my slide about the bomb, if you retire with all of your assets in an IRA or 401k, all that income is taxable when it comes out, and you have no choices. So you're looking at a bigger tax bill than if you had a blend of accounts between just taxable brokerage accounts, Roth IRAs, and regular IRAs or 401ks. Good question.
There's another question from that same woman. Should you drop to part-time 2 years before anticipating retirement to reduce Medicare premium?
Ask that question again.
Should you drop to part-time 2 years before anticipating retirement to reduce your Medicare premium?
Not necessarily, because the first year you collect Medicare, if you retire and then file for Medicare, you can usually file the SSA 44 and say that your income you have an exception to the high income because you were working. And so you can deduct your prior work income. And then you're really only hit with that if you have a lot of other income, not your employment income, or if you start collecting Medicare and you're still working. For example, if you work up through into your 70s.
Hey, Jen, you mentioned 501c3
Yes.
charities. How do you find out if the charity you want to contribute to is a 501c3?
It's a good question. The IRS maintains a list. I think if you Google the IRS and 501c3 charities, you might come upon it. You can also look at, there are a couple organizations, websites that publish information on all the charities. One is GuideStar.org, and there's another one whose name I've forgotten that's really good, but I'm sure. Charity Navigator, that's the one. That's excellent. So either of those two sources are good sources, or you can look at the IRS website.
I have a question.
Yes.
So I have a LLC, New Hampshire LLC. I'm
Yes.
the only member.
Yes.
Is it best for me to file my taxes through our joint taxes, or should I have my LLC done separately?
So if you are the only member of your LLC, it is, or actually, no matter how many members, it is not optional. So if you're the only member of your LLC, then it goes onto your personal income tax return, your Schedule C.
Okay.
In New Hampshire, it's different. Your New Hampshire tax return, you will have to file a separate business tax return for New Hampshire, depending on your income. If your income is over $50,000, you have to file one certain type of New Hampshire income tax return, and if the total revenue is over $222,000, you have to file yet a different tax return that offsets each other. But New Hampshire is different than your federal tax return.
So going back to the charity,
Yes.
is there a maximum charity donation deduction?
Yes, but anything you can't deduct carries forward. And I believe that the current, for cash charity, you write a check to the charity, it's 100% of your adjusted gross income. You can't deduct more than your income, but that has been a lot lower in the past. It's been 50 or 60% of your income in the past, but whatever you couldn't deduct carried forward into a future year. If you give appreciated stock or appreciated assets of any kind, those are limited to 30% of your adjusted gross income. But whatever you can't deduct in the current year will carry forward, I believe it's up to 5 years. So it's not lost, it just moves into the next year. Great questions.
How do I figure out the tax consequences of a sale of property ahead of time? Because it's pretty complicated, it sounds.
Correct. It is complicated, but if you have all of the pieces, you can sort of write it into the formula to approximate what it is. If you know the approximate sales price, you know what you paid for it, you know how much depreciation you took, you know what commissions and other expenses you're going to have, you can rough into a total profit line. But, big but, you really have to do a tax projection, which is very difficult to do. A tax projection is a mini tax return. So, and I'm not aware of any, there probably is software that does this for consumers, I'm just not aware of it, but like we prepare tax projections, we have special tax projection software that we prepare tax projections for everybody, but I will not answer a question for a client based on how's this going to affect my taxes. I will say, I have to run your tax projection, because even we don't realize all the ways it interacts. Will be like, holy cow, did you realize it's going to do that? So, and so you really need to do that. So we like to do multi-year tax projections to see what is the best tax year to do a certain strategy. But I will tell you that right now, the tax strategies that all the CPAs and tax preparers are looking at are bring income into 2021, because most likely tax rates are going up next year. So if you have high income, or if you have I have some people that have one-time income events. Their income is not normally over $400,000, but they're selling their business. So now their income is going to be $800,000. So you want to date that transaction in 2021 if you can, and not bump it into 2022. But again, if it's a capital gains thing, like selling a piece of property, you're already locked into the higher tax rate if this law passes, because they wrote it in that it would be effective September 13th, the day it was issued. That's all the questions. Thank you very much. Appreciate it. Join us next week for retirement.